I'm going to show you how you can afford to purchase a home here in Orange County, California, where the median home price is $1.2 million. I'm often getting people reaching out going, who is buying these homes? Who can actually afford to buy a home when the median home price is $1.2 million? Well, understand, it's not just one demographic out there buying properties. It's not just those with large down payments, those move-up buyers. It's not the senior community. It's not just the luxury space or investors. It's also first-time home buyers. And the reason I know this is because I personally work with a lot of first-time home buyers going through the home buying process. So that's exactly what we're going to talk about in today's video. The conversations that I'm having with first-time home buyers who are looking to get into the Orange County housing market and looking at the crazy prices out there and then looking at their budget and going, how am I actually going to make this happen? On top of that, we're not only going to talk about the median home price, we're going to talk about the salary that you need in order to afford that median home price to give you an idea of where your income needs to be if you're looking to purchase something around $1.2 million here in Orange County. But before we do that, I'd like to take a minute and ask a favor. If you find any value in my videos at all, do me a favor and hit that thumbs up. Also, feel free to subscribe to the channel to stay updated on everything Orange County and real estate related. So let's back it up here a minute and talk about the income that you need to be able to afford the median home price here in California, because housing affordability is sitting near all-time lows, and that's because home prices have continued to rise over the last couple of years, while at the same time mortgage rates went from 2.5% upwards of 8% in just a short period of time. So affordability has become completely strained across the board, and that's one reason that we saw existing home sales fall so much in 2023, and that's because there's just less able buyers out there in the market. The market is always made up of two types of buyers: the willing and the able. The willing are those that are willing to buy a home when the opportunity presents itself. But unfortunately, not all the willing are actually able to buy a home. Some of them don't have the down payment. They don't have the credit scores. They don't make the salary necessary to be able to afford the home that they want to purchase. And that's exactly what we saw as mortgage rates rose last year. We just had less able buyers out there in the market. So let's take a minute here and talk about the income that you need if you're looking to buy in Orange County and what you can do if you're a home buyer to put yourself in the best position to be able to afford that price point, or maybe even something around it. So for calculations in today's video, understand I'm just doing one calculation, one simple calculation using 20% down in order to determine how much income you would need to be able to qualify for that home. Now, I realize a lot of people watching this video don't have 20% down. You might have 5% or 10%, and in some cases maybe you're putting even more money down. But understand, if you're putting more money down, then you'll need to make less income than we're talking about in today's video. And if you're putting less money down, you're going to need to make more income in order to be able to afford this median home price. So when we look at the purchase price of $1.2 million, if we're putting 20% down, that's $240,000, which means you're financing $960,000, which essentially is a high balance conforming loan, which means the interest rates are going to be slightly higher than those of conforming rates, but still really, really good based on today's interest rates. So we're going to use a 7% interest rate in order to calculate today's payment, which means if we're financing $960,000, that mortgage payment is $6,387. Now, on top of that principal and interest payment, you're also going to have property taxes. Property taxes here in Orange County are usually estimated somewhere around 1.25%, which breaks down to $15,000 per year or $1,250 per month. Now, on top of the principal interest and the property taxes, you're going to have homeowners insurance for that property, which is going to run you somewhere between $200 and $250 depending on the type of insurance you get. Now, in addition to that, you might have fees like an HOA, or if you're putting less than 20% down, you might have mortgage insurance. But for today's example, we're not using either of those, which gives us a total monthly mortgage payment of $7,887 per month. Now what we need to do is work backwards to figure out how much income we need to be able to qualify for a home like this. Now, understand, when doing calculations like this, it's very difficult because we don't have a real borrower in mind. We don't know how much monthly debt they carry, and all of those things are going to be factors in determining how much income you need. So for today's example, we're just going to say you don't have any monthly debts that show up on your credit report. So you don't have a car payment, you don't have any student loans, your credit cards get paid off every single month, you're essentially debt-free in this example. Now, if you did have debts, you're going to have to factor those in to your debt-to-income ratio to determine whether or not you qualify. But for easy calculations here, we're not going to do that. What we're going to do is start with a salary of $200,000 per year. Now, in order to figure out debt to income ratio, how much we need to figure out what your gross monthly income is. Now, your gross monthly income is income before any taxes. So if we know you make $200,000 per year, we just divide it by 12, which gives us a monthly breakdown of $16,667 per month. Now, what we do know is that conventional financing will typically go to somewhere around a 49% back-end ratio, which is your housing expenses plus any monthly debts you have from your credit report added together and then divided into your gross monthly salary. So if we took 49% of $16,667, we know that amount is $8,167. Well, earlier we said our mortgage payment was $7,887. So it's less than the 49% back-end ratio in this case, and we said we didn't have any monthly debts. So assuming we could get a 49% approved with conventional financing, which may or may not happen because it is towards the higher end of that ratio, and we haven't really talked about credit scores and other compensating factors, we're just giving examples here, you may or may not qualify for that property. You're at the very high end of that threshold. So let's take it up a little bit higher in salary and say that you make $250,000 per year. Well, that actually breaks down to $20,883 per month, and with a 49% back-end ratio, we can use $10,208 per month with our housing expenses and our monthly debts, which means a mortgage payment of $7,887 on the median home price that we talked about is probably doable. So in all reality, you need to be making somewhere between $200,000 and $250,000 and being able to put 20% down, have good credit in order to afford the median home price here in Orange County. Now that can be scary. You're probably watching this going, Jeb, I don't make $200,000. I don't make $250,000 combined with my spouse. That's a lot of money. And on top of that, I don't have 20% to put down on that property in order to buy it. What are my options? Well, that's really what today's video is about. We're going to talk about what you should consider if you're a home buyer out there at the moment and you don't necessarily have the ability to be able to purchase this median price home. We're going to talk about the things that you need to consider, what you need to look for, along with some things that you can do on the loan side to put yourself in a better position. Now, as we're doing this, I want to reach out with a shameless plug. If you're here in Orange County, you're a first-time home buyer, you're a move-up buyer, you're looking to buy real estate and you don't have a real estate agent, I would personally love to guide you through that process. So do me a favor, reach out to me directly so that I can personally walk you through this process and ultimately help you accomplish your goal of becoming a homeowner. Now, as a buyer in the Orange County housing market, there's one thing that you need to understand. The median home price and below is the most competitive price point in the market, in our market. It is the price point that gets the most offers. It's the price point that gets the most showings, the most people at an open house. It is the most competitive because it's under the median home price. That means there's more able buyers that are able to qualify to buy a home. Therefore, the competition is a little bit higher versus looking at a property that's $3, $4, $5 million. There's just less people able to do that. Therefore, competition is less. So as a buyer looking in this price point, just understand it's going to be competitive, but it's not a reason to run away and say, I don't want to do this. I'm not ready because I don't want to deal with competition. Understand you're going to be dealing with competition anytime you're under that median home price. And the median is just continuing to go up, which means there's more and more people getting pushed under that median. But if I was a buyer out there at the moment looking to buy in Orange County, what would I be looking for? Well, I will tell you, the most expensive areas are typically coastal areas. So if you came down from Long Beach, you could say Seal Beach, Huntington Beach, Newport Beach, Laguna Beach, San Clemente, Dana Point, San Juan Capistrano. All of these areas are typically your more expensive areas in Orange County because they're coastal. So if you can't afford the coastal areas, if you will, if they're all too expensive, what you have to do is go a little bit inland. And I'm not talking about driving to Barstow, but you just go a little bit inland, maybe a couple of miles inland. Property typically becomes less and less expensive the more inland that you go. And in turn, you're going to get more bang for your buck when it comes to property. So if you're only looking at single family homes, The further you go inland, the more property you're going to get for that same dollar amount that you could maybe get at a coastal property. But on top of that, if you're somebody that's just looking at single family homes, you might consider looking at townhomes, looking at condos, looking at other types of property. Now, I know some people out there don't want to be attached. I hear it all the time. I will never live in an attached home. That's completely fine. You have to do what is right for you. But sometimes you have to do things that you don't really want to do in order to have the things that you want to have. And in this case, you might look at townhomes, condos. Some are built differently than what you might have in your mind, and in turn might offer a more functional layout than a single family home. Here in Huntington Beach, where I'm located, the median home price of $1.2 million here gets you a 3-bedroom, 2-bath, something around 1,100 square feet or so. So a relatively small property compared to what a lot of people out there are used to. Now, in the same market, you can find townhomes, even condos that are 1,000, 1,100, 1,200 square feet that are significantly less than that same price property. So not only are they less on the budget, they also offer as much square footage as that single family home with potentially less maintenance depending on what you're going for. And the other thing I want to point out is that if you're somebody out there looking in the market right now, I know a lot of people want that perfectly remodeled home, the one that shows up on HGTV, the one that has everything finished, the beautiful kitchen, the bathrooms, you know, the perfect flooring, the paint, it's just turnkey. Understand, that property is the one that's in highest demand and is typically going to get the multiple offers and go above the asking price. So if you're a buyer out there at the moment, look at the ugly house. Not necessarily the ugly house, but the one that doesn't show quite as well is that turnkey property that I just mentioned, the one that needs some work, or maybe even the one that's been on the market for some extended period of time. Maybe it has a little bit of a funky layout, but you in your head can see a vision at some point in the future where that can be modified to make it what you want, because those properties aren't in as high of demand as those perfect turnkey properties, which in turn means you're typically able to get them for a more reasonable price, and there's usually less competition on it, which in many cases may offer a lower monthly payment and put you in a better position overall. Now you might be watching this going, Jeb, I've tried all of that, none of that works. Well, your next option is to try to increase your budget. Now, how do you go about doing that? Well, the very first thing I would tell you to work on is your credit. If you don't have perfect credit, if your credit isn't above a 780 credit score, you can improve your credit. And improving your credit will put you in a better position to get a lower interest rate, which in turn will reflect with having a lower mortgage payment. So the higher you can get your credit score, the better terms you're going to get on your loan, which will not only offer you potentially a lower mortgage payment, but could potentially let you qualify for more home. So maybe by improving your credit score, your budget actually goes up on the housing side. So now instead of looking at homes that are at 1.2, maybe you can go up to 1.3 million, which adds more potential inventory and gives you more opportunities. In addition to that, if you've got a property that's been sitting on the market for a while, you might talk to your real estate agent to see if it's possible to get the seller to give you a credit so that you can buy down the mortgage rate. By buying down the mortgage rate, you're going to put yourself in a better position with that monthly payment and potentially qualify for more home, just like we talked about a moment ago. And on top of that, another thing you might consider, instead of taking a 30-year fixed mortgage, maybe you take an adjustable rate. I just sold and bought a home about 4 months ago, and I took an adjustable rate mortgage on that loan because the adjustable rate was about 0.5% lower than the 30-year fixed rate. Now I know some people are worried, well, what happens when it adjusts and all of that stuff? Understand, it's a 7-year adjustable. I'm pretty confident that mortgage rates are going to come down before that loan starts adjusting. So I'm going to be able to take advantage of a lower rate in the future. Now, I understand it. I'm completely comfortable with it. Some people aren't. So you just have to do what's right for you. But if you're one of those people looking to maximize your budget at the moment, then taking an adjustable rate could put you in a better position to qualify for more property. And one of the last things I want to point out that could put you in a better position to afford more home, and you've probably thought about it, but maybe there's an opportunity for you to get a gift from a family member, parents, grandparents, so that it gives you more money to put down on that home. Therefore, you're financing less property, and maybe you can do some of the other things that we talked about to lower your mortgage rate and ultimately qualify for more property, which at the end of the day could help you afford that median home price here in Orange County if you weren't otherwise able to do it. Now, after watching this, you realize, yeah, Jeb, I'm in a position to buy a home. I think I can do it. How would I make my offer stand out if I'm under the median home price and you said it's competitive? What can I do to put myself in the best position to actually get my offer accepted? Well, I did a video on exactly that, which you can find right here.